Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome back to the Private Practice Survival Guide podcast. In this episode, I'm bringing a new guest to our group. We've got the incredible Mark Martukovich. And Mark is not only my own CPA, but actually works with a ton of private practices that I work with. We work really well together. And in this episode, we're talking about tax strategies that actually work. So Mark, why don't we start by letting everyone know a little bit about you, what's going on, what got you to be a CPA, and then how you're transforming the game right now.
Yeah, so it's funny. I got my accounting degree right out of college and never thought I would ever get into public accounting. I went private sector, had a number of different jobs in the private sector, but I was always drawn to working with small businesses. I spent about 10 years as a commercial banker just before I came into the practice. And I really enjoyed working with small business owners and helping them figure out how they can grow their business, how they can expand, how they can eventually exit their business. And to me, I'm just like a problem solver. I like working puzzles and I like helping people figure things out. And so just naturally working in tax and helping business owners navigate through, the planning side of things for me is really something that's appealing to me. I think most businesses don't really have a tax problem. They have a planning problem. IRS rewards people that plan ahead. And if you know how to navigate the system, I think you're going to have a good outcome. And so there's a big difference between people that, just kind of react to things and final forms versus somebody that gets ahead of the game and that tries to kind of affect the outcome. And that's where I want to be. I want to be in that space where I'm helping business owners really just kind of navigate and find ways to do things better and, ultimately not pay any more than they need to in taxes, but have good outcomes.
Absolutely. And I think that's the hardest thing is people, you said something that I really liked. One of the things you said is not have to pay more taxes than they're supposed to, or they have to. There's this code, quote unquote, right? There's a tax code. And the reason why we hire experts in this field is to help us navigate the tax code. And so I guess one of the questions I have for you is what do you find is the single biggest tax deduction that most small business owners are overlooking? Is there anything that you see as just those that are going and just kind of filing their own taxes or whatnot, or not hiring experts, are missing when it comes to the tax code?
Yeah, and Brandon, there's a couple that come to mind, and when we talk about helping small business owners, there's a lot of leakage points, things that people just miss because they just don't know, or maybe they don't know how to do things. And so one of the biggest things we see with, practices or medical practices in particular is they're paying for a lot of things, but they don't have a good reimbursement plan in place. And so a good, perfect example is many business owners now work from home in some capacity, and they have space that's set up at the home, and they're not necessarily taking the home office deduction or doing it properly. And some of that's rooted in in the past, everybody thought that was taboo or something that was a red flag or an audit, but it's not. And in fact, we learned several years ago with everything that happened that people can work from home and do work from home. So that is a big area where we try to educate people. It's we educate them on the right way to do it, and that there are expenses that you can take that are really business expenses because you're working out of the house and you're supporting the business. And the IRS allows you to deduct those things. You just have to know how to do it. So putting that in place, that's one of the big ones. And then one of the other areas where we see some, I won't say misses, but opportunities, let's call it, retirement planning and retirement stacking. And so when you have a business, and we always tell our business owners, we want you to think of your business as an investment, not just something that generates a paycheck. And many business owners have this engine that can fund whatever goals you have, whether it's lifestyle goals or expansion of the business or retirement funding. We find that the business owners don't know how to really kind of use this engine to fund the goals. And so there's some leak there where they're not, maybe they're just doing like, oh, I've got a 401k, or I'm doing I'm contributing to an IRA, but there's so many more advanced things that you can do to affect the outcome. And then again, fund those goals that you might have. So those are the two big ones that I see that, there's really good opportunity for business owners that own practices that, they can capitalize it. And like we said, not pay any more than they need to.
So again, simple things: home office and
Yeah.
retirement, how we structure it. What I
Yeah.
also find is that there's a lot of, we'll say, tax deductions that people take, but they don't always recognize what that tax deduction represents. So I find a lot of practice owners are utilizing the commercial vehicle tax deduction. And again, I'm throwing this out there just because I find these people are driving G-Wagons and I'm like, how do you afford a G-Wagon? They're like, oh, I got 70,000 in tax credit on this thing because it's my commercial vehicle right off. Talk to me about that specific tax deduction, because I do see it, what I would call abused at times.
Yeah, and so you have to be careful with the business vehicle in the situation because, um, you know, there's a component of it that is tax deduction, but there's also a component that's risk and kind of avoiding risk. And so we often have discussions with people. They want to go buy a vehicle because they want to get the big tax deduction. So we're always getting calls from somebody sitting at a dealership in December saying, all right, I'm going to buy this vehicle because I'm going to get this, big deduction because of it. And how do I title it? Or what do I have to do? Or should I lease it or buy it? And so on and so forth. And so we get those questions often. And this is something that we don't want to wait until you're sitting in the dealership to have the conversation, because there's a lot to this puzzle here. Business vehicles or mileage that you take, there's different ways that you can deduct it. Some of it you can run through the business. Some of it you can still, if you own the vehicle personally, you can still take deductions. And essentially you're going to get mostly to the same result. But the real conversation is, if you have a vehicle, how much do you use it? It's got to be more than 50% used in the business if it's going to be a business owned vehicle and paid for by the business. And so that's the first part of the conversation. And that requires some tracking. So you have to track the miles that you drive, and you got to substantiate that. But the other side of that is, if I own the vehicle in the business name, there's exposure there. And with that exposure, if, and heaven forbid, if somebody got into an accident in a business vehicle, now your business is at risk. And because they have access to the entire assets of the business. So a lot of times that conversation is about, okay, can I take the deduction, or how can I take the deduction? It's really, how can you avoid the risk and still take the deduction? And there's different ways we can do it, and we can get to pretty much the same result, but also avoid the risk. And so that's a big important piece to that conversation. And so when we talk about taxes, we don't just talk about, okay, you can save X, Y, and Z. We got to talk about what are the other intangibles and variables that need to come into play, and that's one. But kind of getting back to the whole, can you do it? Is there some benefit? Yeah, certain vehicles have certain, tax breaks associated with them. If you buy a vehicle that's over a certain weight, you can deduct the full amount in the first year, and that could be a good tax planning tool. If you have a good year and you want to try to absorb some income, and you need the vehicle, then go ahead and buy it. One of the other things I always tell people is, you don't want to spend and put money out just to get tax savings, because you still got to spend the money, right? If I'm spending $100,000 on a vehicle to get a 37% tax break, I'm still out the 63%, right? So, you don't want to just buy to just get the tax deduction. You have to do it in a prudent manner and do it in such a way that you're planning for the business and doing the right thing because you need to. And so those are all conversations around that. And it's interesting how when we get into talking about one specific thing, it opens up conversation about several pieces that all need to come into play, right?
Yeah. Yeah. No, and I run into this all the time. I see business owners, and the statement that they make is, Brennan, how do I not pay any taxes? And I'm like, well, right off the bat, like, do you think that the code is set up for you to not pay any taxes? And I'm asking you, Mark, I guess, My question is the tax code set up for business owners to never pay a single dollar in taxes?
No, I mean taxes are a good outcome, and if you're paying a lot in taxes, hopefully that means you've got good planning and you've got a lot of income behind that, right?
Yeah.
The key concept is you don't want to pay any more than you need to. You want to pay your fair share, right? And so very important that you navigate through, the code to do the right things. And there are advantages with, if you have a good planner, there are certain things that you can do, levers that you can pull, and so on and so forth that can get you to an outcome where you're not paying more than you need to. And that's okay because that's the way the tax code's designed. But businesses do pay, ultimately business owners pay taxes. The businesses may not because of the way it's structured, it flows through the individuals. But, again, the key is you don't want to pay more than you need to. The IRS allows you to deduct anything that's ordinary and necessary to run the business. But here's the thing, if you're operating a business and you show a loss every year, you're not showing any income. Well, why are you running the business? Okay, you've got to make profit so that you can have lifestyle and you can support yourself and do whatever you need to do. So, that you have to make a profit in your business at some point in time, and then when you do, there's going to be some tax that you have to pay, and that supports the greater good, if you would.
Well, and I bring this up because even when we sell a business, if I'm showing no profit year over year, and then I go to sell it and I show some crazy add back, you don't think the IRS is going to come after me at some point? Like it's going to catch up. Am I right?
Well, absolutely. It's like, one of the audit risks is like big variances. If just like you said, if you're clipping along, no profit, and all of a sudden you spike it, that's going to raise some questions. And, with the technology that they're trying to put in place with the IRS, they're going to start catching more of that because you can use some automated technologies to kind of recognize those big variances. So that's one thing that you have to be careful because it is an audit risk. If it's explainable, that's fine. Just you can explain it. But when we talk to business owners and we talk about the exit strategy, we want to have at least a 5-year window when we talk to businesses so that we can plan, and we want to groom that business, if you will, for sale. And what I mean by that is you want to show profitability because chances are your business is going to trade on either a multiple of profits or, some sort of efficiency. So if you're not showing profits and you're going to get, 5 times 0 is still 0, right? So it's not good. And so I try to talk to people about, in planning for the exit of a business, if you save $1 today, if you pay $1, let me back up there. If you have $1 today in profit and you trade on a multiple of 5 times, you're going to get 5 times that in the future. But if you make that dollar go away, then that 5 times multiple goes away. And so you want to be able to show taxes. You want to be able to show profits so that you can pay taxes in a sales situation. Because if I'm looking at 2 businesses side by side, for example, and I'm a buyer and I see one that has no profits and I see one that has profit, which one am I going to gravitate to? I'm going to go to the one that's got profit because I want to get money back when I'm invested in this business. And so if I'm invested in showing profits, I'm going to get that return on my investment.
100%, 100%. So as we look at practice owners and the way they structure their business entity, is there any recommendations you have to kind of minimize that lifetime tax burden or things related to structuring their entity that helps?
Yeah, entity structure is very important with business and practice owners. And by default, the odds are not stacked in the business's favor, right? So if you just open up an LLC, for example, and by default, if I'm the only owner of that LLC, by default, I'm a sole proprietor. And what that means from a tax perspective is that every dollar I make in that sole proprietorship is subject to not only federal, maybe state taxes if you're in a state that has taxes, but also Social Security, Medicare, the payroll taxes. And so that's a little more than 15% in additional tax. And so there are things that we can do if we can get ahead of the game or talk to business owners about structure to affect the outcome and change things. So we would restructure that business, not the entity per se, but the way it's taxed. So we can elect to be taxed differently in this scenario, an S corporation, for example. And in doing that, now I can say this money that you have as profits, I can carve out some of it as wages, which is subject to payroll taxes and federal and state taxes, but some of it's profit, which is not. And right there is a big 15% opportunity to save on taxes. So entity structure is important. And by default, it's going to just put you into the bad structure. All right. So there's other parts to that conversation, and there's other reasons why you would select certain structures, but that's the very basic one that most people just fall into because by default you're just set up to pay more than you need to, and it's our job as planners to get you off of that scenario. So when you get to the right threshold, and there's a certain dollar threshold where it makes sense to kind of start the strategy, but when you get there, having a tax planner helps you. And when you think about that, over time, the tax savings, 15% of, let's just say you're making 100,000 in profits, 15% every year, if that's going to the IRS without any planning, you could pull that back, put it in your pocket, do some things with it, and just imagine what you can do with that kind of investment every year.
Absolutely. Absolutely. I mean, I remember when we first met, and entity, one of the things that I think business owners don't recognize is the entity that you choose from a liability standpoint can be different than the entity that you get taxed as. So a lot of people don't recognize that your taxable entity, how you define yourself to the IRS, is different than the way that your lawyer is setting you up from a protection standpoint.
Yeah, and it can be. And that's a good point there, Brandon.
So when we're looking at, do you have any feedback on the Augusta rule and how practice owners may use that?
Yeah, so the Augusta rule, I think it's kind of rooted in the masters. Really, it's something that people would rent their houses out and make a lot of money during the week or so, or whenever they have the tournament. But the Augusta rule is simply it's a way for you to take your home and rent it to the business without claiming the income, and you can do that for up to 14 days. And so with that, you can have a staff meeting, you can do planning, for your business, and you can pay yourself a fair rate for that. So what you would do is you go find out what meeting space at maybe a local hotel would cost, and you can charge that amount to your company. Company can pay you. The company gets the expense for paying you, but you don't have to claim the income personally. So it's a way to take money out of the business and put it in your personal pocket without having to pay taxes. So it's kind of a neat little thing. But the keys there, you have to document everything. You have to document that fair rental value. So if you're going to do it, again, find out what the local meeting space is. You have to have it for meetings. There are things like board meetings, planning retreats, strategy sessions. It's got to be, something work related. And you have to document kind of an agenda there. So you have to have the minutes. You got to do a proper invoice. You got to pay that money from the business to the owner. And if you can do that, you can shift some money there. I'll give you a good example. There's a contractor we were dealing with. They've got 12 different meetings every year that they run. Okay. And, with that, he's shifting about $18,000 out of the business to himself personally, not paying tax. And if you're in a 24% tax bracket, that could be a pretty significant number. So definitely something people don't take advantage of. Again, documentation is key, but it's a strategy that allows you to rent your place, from yourself through the business, up to 14 days a year.
And I only bring this up because so often we put on in private practice events for our team. I have a client that literally does leadership retreats at his house. He's got a pickleball court. They do leadership, They do barbecue, they do all of that. And once a quarter, they'll do literally like a 2-day retreat or something. And
Yep.
I think that sometimes we don't recognize, we just look at it like, well, I don't have to pay for the space, but we don't recognize the way that the business could pay for that expense
That's right.
and the
Yeah.
tax ramifications or tax benefits in this case. So there's a lot
Yeah.
to know. And so the one thing I want our audience to recognize is that tax planning is about planning. And if you're not investing in strategy, you're often missing the mark on how to optimize your bottom line. And so,
Yeah.
Mark, why don't you share with everyone how people can get in touch with you? We'll also have it in the show notes. But Mark's practice works with private practices and small business owners throughout the United States. And so that's one of the things why I love working with Mark, because many of you know I have businesses in different parts of the country, and having someone that can help you strategize for where your employees reside, where your different businesses practice and operate is really crucial. So Mark, how do we get in touch with you?
Yeah, so very simply, our website is bisadvisory.com. So that's BUSADVISORY.com. On our website, if you're a business owner or an individual that wants tax planning, there's a link right on the homepage. Click on that. It'll allow you to fill out a little bit of an assessment for us, give us some information, and then schedule an appointment so we can have a conversation. We do offer a free initial conversation where we just kind of unpack what you got, what you need, and then we could talk about ways that you can help. And so that's the easiest way to get to us. Email markm@bisadvisory.com. Always willing to talk to business owners, love to talk to people. As you said, we have clients all across the country, very easy to do Zoom or Teams meetings, and we can have some very effective conversations. And, again, our business is about proactive planning, not reactive, tax preparation. And there's a big difference between an accountant and an advisor. And the advisors are people that you think of as an investment. You expect to get a rate of return from the conversation that you have with us. And that's something that we really believe in providing that to our clients.
Absolutely. Absolutely. So bisadvisory.com, check Mark out. You'll also get to hear from him on future episodes. Thank you so much for tuning into this episode of the Private Practice Survival Guide podcast. Don't forget to like us, subscribe, write a review, share us with your friends, because together we can thrive, not just survive. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you love this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.